welcome. I'm Matt Fifield from Pacific Road Capital. With me is an operating partner of ours, Ian Maxwell. Hi, Ian.
Good day, Matt.
So today, we're very pleased to be joining One-to-One APAC, and we wanted to cover a couple different things for your attention. First, we wanted to talk generally about what we're thinking in the world, trends that we're watching that might be of interest to investors generally and to some of Australia's fastest growing juniors. Second, we wanted to speak a little bit more about how those trends are reaching out into the broader investment universe and what we're focused on as investors and as concentrated investors with our portfolio companies. And then third, I think we'll close down talking a little bit about, in particular, the new tailing standard that's come out from the Church of England and Swedish Council of Ethics, of which we had a little bit of a part. So if we step back, for those that aren't familiar, Pacific Road is a dedicated mining investor. We manage 2 private equity funds with roughly $800 million in commitments. We manage money on behalf of high net worth family offices, on large pension funds and endowments. And normally we're investing into listed and unlisted, but predominantly listed companies, and in a concentrated fashion, where often we're the largest shareholder in a public company. And we own some companies outright privately, and then we also make minority investments as well. So it's across the space, but mining specialists. I'm a former mining executive, as is Ian, as is many of the people on our staff, and also have spent a lot of time in financial services. So coming at it with really an investor's mindset on the sector. And as we sit here today, I think that there have been a couple of big trends that we've been following for a while, Ian, now, that are really accelerated in a post-COVID universe. In particular, the focus on battery metals and strategic minerals, and sort of the breakup in supply chain of US and China. And then also how those, what I'll call nichier investment spaces, are also being influenced by qualitative and how you do business ESG factors, about which we speak quite a bit. So let's step back for a second. And I guess, Ian, look, we've talked a lot about the sort of the decentralization of supply chains through China. What are your thoughts on that?
Yeah, look, it's an interesting area, Matt. I mean, I think you raise critical minerals and battery minerals as 2 particularly topical areas of which they are. I think one of the emerging trends that I see, and I know you see as well, is the involvement in the customer in those supply chains to a much greater degree than we've seen historically. And you can see that through moves such as Tesla and Tesla's Battery Day, but also the Chinese battery manufacturers buying into minerals projects in Australia and Africa to underpin their production facilities. Clearly those companies either sell directly to consumers, or they sell to car manufacturers who sell directly to consumers. And those consumers have a very strong ESG focus. They want to know that the goods they're buying, the products they're buying, have been put together the right way, in the right ESG standards, and are clean.
Well, what I was going to say, it's interesting. If you step back, look, this started in the consumer products world, right? And around some of the conflict minerals. And you drop back and you look over time at the progression in disclosure and supply chain analysis from the likes of, could be Apple, could be LG. I was looking through both of their sort of upstream disclosure statements the other day. And one of the things that's just, it really sticks out is that most of the things that are being certified, maybe US, Europe, 1 or 2 other random places, in China. And so much of the intermediate supply chain moves through China across the entire range of strategic minerals, but commodities on the whole. And it is a fact that the downstream producer of sold goods is interested in the inputs that go into it, but then they feel very remote from the actual projects themselves, which sit through an entire chain of intermediate products. How do you think customers are going to be moving more in that direction? Do you think they'll start taking direct stakes in projects like we've seen, for example, in metallurgical coal?
Yeah, I mean that's a very interesting question as well, and I think it's worth going back and examining why the situation that we have now exists in the first place. Really, through the 90s and early 2000s, we moved those supply chains to China because of the lower cost of capital in those areas, and possibly in part because of the lower standards around manufacturing and smelting and other areas that existed, which just made final raw materials production in some of those jurisdictions cheaper. And we really offshored the processing of minerals to a number of countries, of which China is extremely important. I think what you'll see is companies that are concerned about their customer wanting to take control back of that supply chain, and whether that's directly by investing in facilities outside of China, be it in the United States or elsewhere, or through greater control of the supply chain, which human rights and other legislation really requires one to do in any case. There are a number of mechanisms, but I do think that when you look at the total cost of a delivered final product to the customer, oftentimes the minerals component of that is not particularly high, and paying a little bit more by investing in that capital and having both security of supply and knowledge that your supply chain is clean is a very viable option. So I do think you'll see, whether it's in the European Union or the United States, more manufacturing of products coming back to those regions which we've traditionally, offshored. But I know, Matt, you've thought a lot about this, and we've talked a lot about it. I'm interested in your view as well.
Yeah, look, there's a certain amount of consistency in where, so our house view is that the stimulus to date has largely been predicated on keeping people, comfortable is the wrong word, but keeping people and the economies moving during a time of great disruption. And as we look towards remobilizing economies back beyond sort of the 70%, 60% areas where they're moving now, and growing job growth, you also have to take into account that that there's a lot more stimulus to come. Formative for gold, and that's why we're continue to be interested in investing in gold. But beyond that, I actually believe when you have pushed a lot of money out, it's going to be very natural for governments and big blocks of economies to want to be more protective and reinvest in jobs, both internally, domestically, and in the economies of their friends. So basically, it's, I think what we're seeing is an acceleration of that trend between U.S. and China starting to drift apart. And the crux, the part that I think is very interesting, is that you have minerals distributed all over the world, resource projects all over the world. Yeah, that's relevant, but the upstream smelting and infrastructure is largely concentrated still in China. So I believe in the next 5 years, we're going to see copper, tin smelters, aluminum smelters being reestablished, counter trend in, Canada, US, Mexico, Australia. You're going to see more investment in that processing capacity. Will it take up 100% of the supply chain away from China? No, and it doesn't need to. It just needs to be a signal that we're willing to invest in that capacity, because ultimately that's also a very long road. When you invest in that capacity, with that comes jobs and knowledge that were lost over a generation. And by making those investments now, you'll regain some of the capabilities that were lost. So that's kind of, I think.
But there's a couple of things there that I think are worth saying as well. I mean, I've done quite a lot of work with Chinese companies over the years, and
Sure.
I think it is safe to say that as in the Western world, there are the good, the bad, and the ugly of companies. The same is true in China as well. And
of course,
there are undoubtedly outstanding companies in China doing outstanding work. And I think, one can look to companies like Catel that supplies to BMW and Mercedes, extremely robust on ESG approaches and doing a fantastic job. But the flip side is you also have, facilities in China that we know are well below Western world expectations. I think you could also say the same is true in the Western world.
It's interesting. I don't think, to come back on that point, I don't actually think that to be accurate, I'm not sure how deep the truth of pro ESG, anti ESG, state-owned capitalism versus private capital sector really is. Most people in general in this world are trying to do a good job. Most people are trying to respect, and so that's a very inclusive statement, but the mostness of it is very true. So I don't actually um, uh, uh, probably fully subscribe into for example, all Chinese resource companies are bad. That's patently a false statement, right? So I would back you up on that. But the one thing that I will say is that the perception of that, which is being driven by anti-China sentiment and all of the rest, it probably has never been higher. And those are some of the pieces when you turn now to how do you invest around that trend, right? Given that there is people wanting supply chain resilience, lessen their dependency on China. Here are the 28 to 35 critical minerals. Europe wants to create its own block around batteries and infrastructure to build, its own electric vehicle world. Same thing with the United States. And so you now actually have a kind of three blocks that are starting to emerge. How do you invest around that? Well, I guess when we step back and we look at, when we step back and we look at this, you think about the totality of the or the spread, I suppose, of the strategic minerals, and you have some portion of that very, very hard to invest in because the customer acceptance and the specifications and the intermediate supply chain are so unique and so small that it's very hard to look at some of these minerals. Gallium, it's a byproduct, goes into gallium arsenide, goes into night vision goggles. All the rest. It's both military importance as well as high reliance on China. So there are a bunch of pieces around that. It's very hard to invest on gallium. I think when you step back and you look at other ends of the market that are defined as large strategic minerals, we see more opportunities for liquidity and growth, and those are things like, of course, all the mineral sands complexes, titanium, zircon. You see tin, vanadium, aluminum, even platinum group metals, and so the broader, more liquid markets, as opposed to those very niche markets, are still going to be subject to some of those very heavy influences that we're talking about. But they're going to be points of more acceptance points, I think would be one way to say it. Or there's going to be more ways to make money, more people to sell your product to, more ways to get out, rather than relying on having a customer come all the way in and you're at the end of the rainbow and you become the pot of gold. Here you can back a team and you can back a project or an operation and sort of move on in some of those broader markets. So in general, one of the ways that we're looking at strategic minerals is to look at the more liquid markets and both look at who's the best incumbent producer and then who are some of the best growth projects that are out there. And that's analysis that obviously we talk about in our meetings all the time. Let's pause for a second. And I think that—
Sorry, Matt, can I just say a couple of other things there that I think are important for investors around strategic and battery.
Of course.
I've got a background in large mining companies with BHP, Rio Tinto, Anglo American, and the reality of and most of these companies have incredibly strong performance standards, and most of the time, notwithstanding some recent failures, most of the time operate at very, very high performance standards, even compared to other industries. But the reality of a lot of strategic and critical mineral spaces is those businesses just do not have the size and scale for the major company investment. So where organizations like Pacific Road come into their own in this space, I think, is in bringing performance standards that are on par with those the major companies have, and being able to invest in sectors and assets and companies that the major companies would never make an investment simply because it would not make a difference to the bottom line. And I think that area is an area where it's going to be a strong growth area in the mineral sector, because we're clearly going to see strong demand offtake in some of these commodities. It's not surprising that the United States and Europe want to in-house some of the supply chain. Having 100% reliance or 90% reliance on a single country is never a smart thing to do. And so bringing that capital formation to both the processing side, but also into the production side, the minerals production side, and doing so with a set of standards that are, world class, and in a space where you're typically not going to get major mining company investment. I think that's it's going to be a really sweet spot for investors.
I mean, obviously it's something that we focus on, right? And I know that the other mining private equity groups and concentrated investors are taking ESG very seriously as well. There's a lot of hidden success stories in there that probably aren't marketed necessarily as well as they could be. But obviously, I mean, clearly I'm in furious agreement with you. What else could I say? In Australia, mining is a core part of the economy, and as a generalization, people are more comfortable with the risks and rewards of resource investing on the ASX than probably anywhere else in the world, except for perhaps Canada and a very distant third in London. And as I said in sort of my opening remarks, most of our investors, or most of our upstream investors, are foundations and family offices, come from the States. And one thing that's interesting to me, the reason beyond the personal value set and alignment around helping build companies that are operating to the best standards that they can, not only for themselves, but for their stakeholders. Beyond that value set alignment, it's interesting because the conversation that I have the most with prospective clients is, why should I invest in resources at all? And that's not something that I think most of the Australian general market really realizes, is that the investing in resources is an option. You can invest in anything. You can invest in hotels in Cleveland, or I mean, it doesn't matter. And so why do I need to go to this risk asset and put my money in that risk asset? And of course, where the generalist goes the whole sector, and the ability to execute on your projects and build great companies. And so in that conversation, that is part of the root of why ESG is so important, is because when you are looking for the broader, large general allocation of capital that comes, many people say this is just too hard. It's an insider game. It requires specialized knowledge, and there's a huge string of warning signs from past performance that tells me that I'm not sure that I should trust the durability of these returns. And I think that as we have worked on our ESG policy over the last 2 years, and been working with our portfolio companies and looking at prospective investments, of course we're trying to improve the quality of that. But behind that, what I would say for all of the board members and senior executives, you need to realize that what's really afoot is, outside of a couple of markets, there's very little, it's very tepid interest even today to invest in the resource markets at all. And so taking that opportunity to put your best foot forward and say, this is why you should trust the durability of my company and returns, and this is why you won't wake up tomorrow with a surprise because we're identifying and managing our key risks. It's just incredibly important, because the health of the capital markets, of course, mining being so capital intensive, the health and activity and interest of the capital markets has so many knock-on effects on the ability to do things. So just as a parting comment, the other thing you talked about, Ian, was you did speak a little bit about world-class standards. And so let's talk about standards for a second. You and I were involved in the tailings standard that was and the tailings initiative that was pushed out by Church of England and Swedish Council of Ethics. and the UN, and as co-conveners. And through ICMM and through a number of other organizations, a new tailing standard has emerged. And what we were doing as a part of that process, I think, was important, is we were commenting on the standard with the eye of, if you're a board member, if you're a corporate executive, if you're an investor in mid-cap and small companies, can you please make it something that people have a chance of being able to comply with and is sensical, so that it's not just the largest mining companies in the world that are going to comply with the standard, and nobody else could possibly meet it. And so that was the role. That was the role that we had there. It's something that's of great interest to us because it's incredibly topical. But I think that most people may not really understand what the standard is and what it's going to mean for them going forward over the next 3 to 5 years. So look, you had a big hand in that. Why don't we take a moment and talk about that?
Sure. Look, I think, Matt, let's put it into context first. You're right. Mining is a risky and scary area for generalist investors. Mm-hmm. And against that, there's probably a handful, 5, maybe 10, real material risks that exist. And we've seen corruption issues, human rights issues, security issues, across a number of operations. I mean, tailings is one of those material risks. The world has tailings failures at a rate of about 3 a year. It's not an individual risk that happens once in a lifetime. It may happen once in a lifetime to a company, but from an investor perspective, they see 3 tailings failures a year. It's a systemic risk across the industry. For a long time, those risks have occurred in operations that have not really been capital markets focused. And then obviously in 2016 and beyond, 2019, we've seen failures in Samarco, BHP and Vale in Brazil, followed by the failure in Brazil in Brumadinho. And you look at the impact of that on investors, and it's been incredibly high. You've got the immediate loss of life in Brumadinho, it's in the hundreds. You've got the environmental damage. Samarco was one of the greatest environmental issues that Brazil's ever experienced. You've got the immediate financial consequences, which have been material to those companies. And then you have this huge long tail of reputational damage, which ultimately prohibits those companies from doing what they are there to do. And you can see that with Brazil, and you can see it in the iron ore markets and what's happening with the iron ore price, even today, struggling to get production back to where they were pre-Brumadinho. So a huge issue, and that's in a big company. So one can only imagine what that looks like if that were to occur with a single asset, or a couple of assets, 2, 3 assets, mid-tier type of company. I mean, it would probably be the end of the road. So clearly a big area, and attracted some real attention, I think, for the right reasons. I think my observation of the companies we interact with and other companies I've interacted with over the years is and you said it at the outset, there's a real desire to do the right thing. I think most people will start their day by saying, look, they don't start by saying, I want to screw up. They start their day by saying, I'm going to try and do the right thing. But I think in today's world, that's across such a broad front of things that sometimes you lose sight of the wood for the trees. And so what the tailing standard set out to do was to say, okay, let's be really clear what performance requirements are required to manage a tailings facility to world-class standards. Let's take all the knowledge that we know about why these things fail, how they fail, etc., and let's start thinking across the main pillars of the communities that exist downstream of dams, the way you design, construct, operate, manage, monitor facilities to ensure they're safe, what you do when things go wrong around emergency response, etc. And let's take world-class standards, put them in place, and articulate that to the world so everybody knows what those standards look like, and it's not just the secret of a guarded few.
So, world-class standards to me is a little scary. Scary is, well, it's aspirational and it is indistinct. Give me a concrete example. What do give me something that's tangible as opposed to world-class standards. And don't worry if it's so technical that our eyes roll into the back of our heads.
I'm going to say one thing about that, then I'll give you a couple of examples. A lot of people spend a lot of time doing things on mine sites to make them safer places.
Mm-hmm.
So whether you do that to world-class standards or whether you're doing other activities that make no difference, ultimately this is not about doing more work or doing any harder work. What it's doing is it's about focusing on the things that matter and
Doing the
doing them
right
well,
work.
regularly and reliable. So it's really about the right work. So if I was a chief executive or a board member listening to that, I'm not sure I'd be so concerned by that. This means there's a tidal wave of stuff coming forward that I've got to deal with. That's not necessarily the case, but it's about convincing yourself that your organization is doing the right things and not wasting time on the wrong things.
Mm-hmm.
In terms of granular type examples, there's different types of dams have different risk profiles. The risk profile of an upstream dam versus a downstream dam versus dry tailings versus an integrated storage facility all have different risk profiles. So one of the things the standard does is to make recommendations that one doesn't use the higher risk approaches, and instead in constructing, designing facilities, you use the lower risk and ultimately try to move towards dry stack tailings, which have the lowest risk profile of all. The tailings standard makes recommendations, for example, around ensuring that you don't get the buildup of communities immediately beneath tailings facilities. And some of these requirements, Matt, are not just focused on companies as well. I mean, I think it's important to say the tailings standard is equally applicable to governments and regulators as it is to mining companies. I mean, this is about creating a safer place for the world. So there's a role there for executives to play. But for example, let's say you have a tailings reviewer, independent tailings reviewer, comes and reviews your site and says, look, on this style of dam and in this particular location, you need 50-meter beaches. Then 50-meter beaches are what you need to maintain. That's not a difficult thing to do. But if you let your beaches go to zero and you've got water resting right up against the dam, don't be surprised if they get waterlogged and fail.
Mm-hmm.
There's a granular example. I think what the tailing standard really does is say, look, get the right independent experts, get the right technical experts in the room, get the right design, construction, get the right monitoring, managing processes, so that when you as a company operate the facility, the time and effort you're spending on managing that, you can be spending on focusing on the right elements and not wasting your time on things that give you a false sense of security.
So thanks. That clarifies, hopefully, for listeners that when you're talking about world-class standards, what you're really talking about are a set of acceptable ways of doing things and the right things that are kind of the critical points that the not only the co-conveners but the ICMM and other participants have agreed on as being relevant. What does this mean? What does this mean for, now that now we have a standard. What happens from here? What does it mean for junior mining companies? What does it mean for board execs, and on for the universe? Give me a picture of where you think it's going to, what this is going to impact is going to have in 2 years, 5 years, 10 years, whatever the time frame you think is relevant.
Yeah, look, I mean, this standard has been supported by the United Nations PRI, the Principles of Responsible Investing, UNEP, and the ICMM. So there'll clearly be uptake in the ICMM member companies, which are the top 30 mining companies around the world. They've all the CEOs have signed up to meet the requirements of the standard. And that will set a benchmark for what industry should be doing. And ultimately, the expectations of that performance will roll down to mid-sized companies. But I think more importantly, it'll happen a bit sooner than that, because financiers, investors, insurers, all the people that look at the mining industry will look to the requirements of the standard. And as they come and look at your facility and your operation, your project, whatever it might be, they're going to be referencing that standard in terms of whether they supply you capital or not, and if so, at what price. And if you choose not to follow the standard, things are going to cost you more.
Look, to everybody that's listening in, I think that it's important to note that this is something to pay attention to, because it's going to be a governor. If it's not now already, silently, it will increasingly be a governor around and help determine somewhat the cost of capital that you have and your access to capital at all. I know that on our side, as we've been looking at investments and acquisitions, we're looking at the standard and using that in conjunction. And I know we're not alone. I know that other investors and insurance, all the way through the insurance industry, people are looking at it. Stakeholders are looking at it. So that just means that you need to look at it. Now, that is something that it's important, and it's kind of on trend where the world is getting more data-driven, more complex, and I think that puts more stresses on junior mining companies and mid-sized producers to move in how they think about running their businesses from the mine walls, or the boundaries of their operations, and think more holistically about how your company operates and fits into the broader world. Because that is effectively is the journey that we're all on in terms of ESG. Now, what I would encourage, we've talked a lot in the past, Ian, you and I, and with our portfolio companies, about transparency reporting. That is another way for you to just start to get in front of things and attract investors. It's going to become an expectation. Realistically, it is an expectation that's not being met. The numbers and the proprietary data that we do when we survey ASX and TSX listed companies show that APAC is behind, on transparency reporting. Yet these are some of the most courageous, best run mining companies we've seen. So there's kind of a mismatch and lag in expectations between, I think, perhaps the market in Australia and the market in North America and Europe. And eventually the two are going to synchronize. So when you step back, it's not just going to be the Pacific Roads and investors of the world that are going to be looking at this. To take us all the way back full circle to where we started, the customers are actually getting more involved in their supply chain. Governments are getting to a place where they are more interested in funding expansion, new projects, projects that are going to bring jobs and infrastructure that is going to unlock some of the tremendous talent and resources that we talk to every day. And so understanding that it's not just the Pacific Roads of the world, but it's going to be government stakeholders, community stakeholders, and customers that are equally going to be interested in not only just disclosure so they can look that you are seeing that this is important, but also performance against some of these standards like the tailing standards. So when you wrap up and you say, these trends were all in place, right? These trends were in place in, actually these trends were probably in place in 2010, right? And then they've been accelerating for a decade. But in this post-COVID world, and when we look forward to a time frame where there's going to be tremendous stimulus and investment that will impact this, the market here in Australia and the markets around the world, be prepared, right? Start with the end in mind, be prepared, start now, and it's a journey. So look, thanks, Ian, thanks for your time. Fun to do this with you. And it's great to talk to the one-to-one crowd, and I hope you enjoyed this. Thank you very much.
Thanks.